Good morning and welcome to Stock Market Today. It's Monday, May 20th, 2019, and I am your host, Dan Russo, Chief Market Strategist at Chaikin Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. And a special thanks to StockCharts.com for hosting this show every day at 9:15 and to See It Market for posting our work on their site every day. I hope everybody had a great weekend. Let's dive right into it. U.S. equities were lower in Friday's trading with the major indexes posting declines for the week. The Tuesday through Thursday rally being bookended by losses on Monday and Friday. Treasuries were mostly stronger with a bit of curve flattening, sending the yield on the 10-year below 2.4%. The dollar was stronger on the major crosses, gold down 80 basis points, and oil was weaker. WTI crude settling down about 20 basis points. Defensive sectors outperformed as a continued focus on trade tensions offset the reported 15-year high reading in the University of Michigan Consumer Sentiment Indicator. So utilities were the only group to finish higher. REITs and healthcare and consumer staples outperformed. Your underperformers, industrial, energy, and tech. And as we get to the desk this morning, S&P futures are down 50 basis points and near their worst levels of the morning after U.S. equities mostly weaker were last week. Financials, industrials, materials led lower on the week. Asian markets were mixed overnight. China did trade lower. European markets are lower this morning as well. Treasuries little change. Dollars flat against the yen and the euro. Gold unchanged. Crude up 30 basis points. And the chip stocks are the real story in my mind this morning, as they are under pressure as the U.S. ban on Huawei's products begins to move through the technology supply chain. You know the importance I place on semiconductors. So here's the S&P 500. Volatility persists as trade remains top of mind. A lot of two-way volatility last week. Interesting to me that two rally attempts were rebuffed right below the 2,900 level. I don't want to crowd the chart here, but we can start to think of resistance in the 2,900 to 2,950 zone. Support 2,775 to 2,800. That 2,800 level did hold last week. RSI did not become oversold, but we have to ask the question, are we entering a new range? Here's the RSI indicator, solidly in bullish ranges as the market was advancing, and now we've come back down. Did not get oversold on the pullback, so that's encouraging. However, on the rally, we failed to get back above 50. So we have to start to think about the potential shift in momentum to bearish ranges and what that could mean for the market. The other shift that can occur is that we could just kind of sit here in neutral ranges and chop around in this wide range between 2,800 and 2,900, call it. Chaikin money flow does remain bullish, so that is encouraging. So right now, a little too early to say. I'm just going to kind of stick to our process. The market is oversold based on our overbought, oversold indicator, which is a little more sensitive than this RSI. For those of you who read my note every day, you're familiar with that indicator. Your market in a minute now. What am I talking about in the note to Chaikin Analytics clients today? S&P 500 holds the 50-day moving average for now. Small cap underperformance remains a big theme. Commodities remain under pressure as the dollar moves higher. The Homebuilders pull back to a compelling entry point. We'll take a look at what that means a little bit later in the show. And as I did say, futures do point to a lower open here today. Taking a look at the major indices from a Chaikin power bar perspective, we can see the Dow has scooted back to a bearish power bar ratio. 5 bullish or very bullish stocks, 6 bearish or very bearish stocks. S&P 500 down 60 bips on Friday, 111 bulls, 79 bears. This is a deterioration over the past week. Well, I will note that it did improve from the bearish range that we saw last Tuesday. NASDAQ underperformer. The tech stocks are going to be under pressure with this news about Huawei, in particular the chip companies that I referenced earlier. NASDAQ down 1%. 20 bullish or very bullish stocks there, 16 bearish or very bearish stocks. And there's your small cap underperformance. A lot of people asking me, why are small caps underperforming in a trade war? Shouldn't they be less sensitive to international trade? And yes, on the surface, that is the right deduction. However, it seems to me that investors are starting to price in what prolonged tariffs could mean for profit margins. And while small cap stocks get most of their revenue here in the U.S., their costs are a little bit more global. And to the extent that tariffs are driving those costs higher, profit margins could come under pressure. 476 bulls, 356 bears for the small caps. Flight to safety sends bonds higher by 22 basis points on price, sending yields lower. According to the Chaikin Power Bar, small cap stocks and large cap stocks are somewhat bullish. Major markets are mixed. Let's take a look at our stock of the day today. Our algorithm generates the stock of the day based on the power gauge rating. And today's stock is Bonanza Creek, ticker symbol BCEI. Oil E&P company, closed at 24.36, down 2.5% on Friday. Power gauge rating for Bonanza Creek is very bullish due to very attractive financial metrics, very strong price volume activity, as well as strong earnings performance. Very bullish stock, strong trend, but a weak industry group. This is one I think we're going to say, let's avoid it for now. Just because I don't like what's going on in the marketplace for energy stocks. This is a very bullish stock. However, it is underperforming the market. So market and model not in agreement. Dynamic duo not in gear. Stock's been an underperformer since last August. And throughout most of the past 12 months, Chaikin money flow has been persistently bearish. Stock is currently overbought. It is above a rising long-term trend line, but it looks like there was some activity, maybe a reverse split. I'm not exactly sure what went on here that's kind of skewed this line. I want to stay away from this one for the time being, despite the very bullish rating. You know my views on commodities. You know my views on the energy sector. Let's avoid this one for now. Sector tracker now, moving to the major sectors over the last 5 days. You can see it. The only groups that are higher over the past 5 days are your defensives and your bond proxies. Real estate, utilities, and staples all higher over the past trading week as the decline in yields has aided real estate and utilities, and a little bit of a defensive positioning has helped the staples. I would say the same could be said for a lot of the communications names as well. Remember, that's a new group. It includes names like Facebook and Google, but it also holds a lot of the older kind of standby companies within the space, your service providers that can be viewed as defensive. Energy, healthcare, materials, and tech are middle of the road over the past 5 days. But again, tech is a group to watch here now that the U.S. has banned products from Huawei, and a lot of the suppliers to Huawei are no longer sending products that way. Underperformers, discretionary, industrials, and financials. The declining rates going to be a headwind there. Our industry in focus today, oil and gas equipment services. Over the past 6 months, this group has underperformed the S&P 500 by 24.72%. And its power bar ratio, which measures future potential, is very weak. 20 bearish or very bearish stocks, only 4 bullish or very bullish stocks, currently ranked number 18 of 21 subsectors. It has moved up 3 slots over the past week, but still a group that we want to avoid. Some of the indicative names there with very bearish Chaikin power gauge ratings: Drillquip, DRQ, Helmerich & Payne, HP, and Core Labs, CLB, all with very bearish Chaikin power gauge ratings. And let's take a look at Helmerich & Payne here today, because I think there could be a compelling setup for a bearish trade, or at the very least, we'll walk through why you don't want to own it. Very bearish stock, weak trend, weak industry group, type of name we want to consider for bearish ideas, and at the very least, avoid on the long side of the portfolio. Now, the market and model are in agreement. Stock's been an underperformer since last October. Intensity of that underperformance is now picking up again as it transitions to that very bearish Chaikin power gauge rating. Chaikin money flow bearish. Stock collapsed on Friday below the declining long-term trend line, and it's nearing an overbought condition. I think you want to start to look at the options market here. Look for put options, bearish put spreads, ways to express a bearish view on Helmerich & Payne might make sense here. And at the very least, as I said, not a name you want to own. Take a look at Helmerich & Payne on the bearish side today. Trending names, Friday's gainers and losers. Under Armour caught an upgrade, sent the stock higher by 8%. Earnings sent AMAT higher, kind of bucking the semis trend for the day, 2.5% to the good side. Final rules from Health and Human Services sent Humana higher by 2.31%. Didn't see any real news to send Fox up by 2.2%. And Nectar sees a little bit of a rebound after unveiling their abstracts at ASCO. Stock up 2% on Friday. Loser side of the board, Deere's earnings and commentary on trade sent that stock lower by 7.6%. Now let's get into the chip stocks. Qorvo and Skyworks are exposed to Huawei. Those stocks headed lower, 6% and nearly 5% respectively. Win has a big presence in China, down 4.63%. And there's your Helmerich & Payne. Didn't see any real news on that one, but the stock was lower by 4.5% on Friday. So energy stocks remain under pressure. We want to watch the chip stocks here today. You know my view on the chips. I think that they're a leading indicator. We've been kind of highlighting the fact that on a relative basis, the chips seem to have topped out. To the extent that that trend continues lower, I think that that has bearish implications for the market. Diving in now. On Mondays, we kind of go through major market themes across asset classes and across different markets. And here we're taking a look at one we've talked about a lot. Small caps are on the verge here. On a relative basis, the IWM, the iShares Russell 2000 ETF relative to the S&P 500. So small caps relative to large caps. We are in a downtrend, right? Below a declining 200-day moving average, topped out back in the June-July timeframe. This is a downtrend. Now, we're trying to consolidate within this downtrend, and now we've tested this support level 1, 2, now for a third time. Should this support level give way, that speaks to risk off in the marketplace. Bullish investors want to see small caps rally here. So far, there aren't signs that we're going to break out of this consolidation yet, as the RSI has now shifted into bearish ranges. Notice the RSI became overbought on this rally attempt, but then quickly became oversold again, and now it's struggling to get much past the 60 level. These are bearish ranges for the ratio, the RSI of this ratio. On an absolute basis, you can see IWM has hit its head on this resistance level in the 157 to 160 zone and has now turned lower once again. A break below 150 carries bearish implications for IWM on an absolute basis, and a break below this support level, obviously, patience for small caps and the market on a relative basis. Something we're watching closely here, something we need to be aware of. I'm watching it daily. 10-year yield is testing support. Here's the TNX, CBOE 10-year S&P Treasury, CBOE 10-year U.S. Treasury Yield Index, pushing on that support level at the 3.37 to 3.4 area, below a declining 50-day moving average, below a declining 200-day moving average. We've been saying it for a while. I've been beating this call that the path of least resistance is lower for yields. It has been playing out. What I do see now, however, is that the yields are testing support, and there's a positive divergence between price and momentum as the RSI of the TNX has put in so far a higher low. I would not be surprised to see the yield kind of back up here a little bit in the near term, but the trend is decidedly lower. I think what you want to do is use a backup in yields that causes a sell-off in a group like real estate, which is now actually outperforming the SPY by our metrics, to look for opportunities to enter there. Also look for opportunities to enter in some of the ETFs that hold treasuries. Look at IEF, look at TLT. Watching yields here closely for a potential bounce and an entry opportunity. Obviously, a break of this support level would carry further bearish implications. We could see downside to about the 2.2% level. Crude oil reaches an inflection point. WTI, light sweet crude oil, after a strong rally up to the $66, $67 area, pulled back to test the moving averages and support around the $60 mark. Now, we do have, you can't really see it, this is kind of an ugly chart, I apologize. 50-day did cross the 200-day, but the 200-day is declining. We're seeing some support here around the $60 mark. Would also note that RSI failed to move to bearish ranges, is now turning higher. Wouldn't be surprised to see rally here in crude oil, but I want to see a break of 67 to definitively say that crude is embarking on a new uptrend. What's interesting to me is despite this rally in crude, energy stocks continue to underperform the market. They still underwhelm me. For crude, Chaikin money flow continues to remain bullish as well after this move back down towards the zero line. I see an opportunity in Homebuilders. Here's the XHB, the S&P Homebuilders ETF, very bullish Chaikin Power Gauge ETF rating, outperforming the market. So the market and model are in agreement here. Dynamic duo in gear for this ETF, which is oversold with bullish money flow above the rising long-term trend line. Good support in the $38, $39 zone. For you ETF traders out there, they can make sense to start looking for some exposure here on this pullback to the Homebuilders. So that is going to wrap it up for today. Head over to chaikinanalytics.com/today. Sign up for the free email. Follow along with this show. It hits your inbox every day that the market is open before the market opens. A lot of the content for this show is pulled from that email, so you'll be able to follow along. I'll be back tomorrow.